Hello everyone, in this video we're going to be going through a bunch of different scenarios for non-monetary exchange. We're going to be going through a bunch of examples for all these different scenarios, okay? So like I kind of talked about in the first video, again, this is one topic where you kind of need to watch the videos in order. The order you want to watch them is non-monetary exchange basics, then you want to kind of go through the formula video. There's a video on the formula of the for non-monetary exchange and how that works. And then we want to go through these problems last, okay? So again, we're just gonna be going through a bunch of different scenarios, and so let's just go ahead and jump in. So it says the following set of facts will be used for all the examples in this lesson. On January 2017, XYZ company traded a piece of its equipment for a piece of equipment owned by ABC. The following information is available related to this exchange, okay? So we have basically a bunch of different things that are given to us. We have XYZ company, and then we have ABC company, okay? Then it tells us prepare the journal entry for XYZ to record the non-monetary exchange under the following scenarios. Okay, so basically we are going to go ahead and prepare the journal entries for XYZ for a bunch of different scenarios of non-monetary exchange. Okay, so the first scenario is that we have commercial substance. Okay, and so what we'll do is that we'll set this up to where we can have both of these papers on showing, so that way we can refer to basically our rules here that we went over in the first video, but we want to just have them handy because it will just be a little bit easier. Okay, so the first one is that it has commercial substance. Okay, so when we have commercial substance, we recognize all gains and losses on the transaction. So this is actually going to be the easiest scenario because it has commercial substance. Okay, so the way I like to solve these problems is that I like to just, so we're doing XYZ company, right? So what I like to do is that I like to just do the easy parts first, and then we do the harder parts last. Because if we can fill out a lot of the journal entry by literally just looking at the information given. Okay, so the first thing I probably would do is credit equipment for 20, because that would be the equipment going out, right? Accumulated depreciation, debit that for 5, because again, you have to take off accumulated depreciation. Okay, we know we're paying out cash of 2, so we can credit cash for $2,000. Okay. Now we have to figure out the equipment and then the gain, okay? The hardest one to solve for is the equipment account, okay? So what we should do is figure out the gain, and then we can plug the equipment account, okay? The other way we can solve these problems is by using the formula. Now, I'm not gonna go through every single one of these using the formula, simply because that would take just a lot of time. But if you were to go back and, I guess, yeah, let's just do the first one or two using the formula. Let's just pull up the formula here really quickly. I wasn't planning on doing it, but let's just go ahead and do it just so we can get familiar with it. Okay. So yeah. So what we'll do is I'll do the first one or two using the formula and the plug approach. The plug approach meaning that you basically solve for gain, and then you just plug this account, the equipment account. This is the new equipment, right? And then this is the old equipment. Okay, the new equipment is the one that's being debited. The old equipment is the one that's being credited, right? Because we're receiving the new equipment, we're getting rid of the old equipment. Okay, let's just, for completeness purposes, let's do the first two using the formula approach just to show that it does work and just to get the equipment balance, okay? And then we will go ahead and, for the rest of them, we'll just use the solution shown here. And then if you want to work through it using the formula, you can do it that way as well, okay? So basically, we have to solve for the gain, okay? Gain or loss, okay? We're going to take the fair value of the equipment, which is $23,000, subtract away the book value. The book value is $20,000 of cost minus $5,000 of accumulated depreciation, right? Cost minus accumulated depreciation is given right there. That means it's $15,000 book value. Our gain is $8,000. Again, we have commercial substance, so we recognize the full $8,000. If we do the math of 30, right? 20 plus 2 plus 8 is 30 minus 5. We get $25,000 as our equipment book value, okay? Then let's just use the formula approach to go ahead and solve this problem as well. So with the formula approach, we start with the old equipment's net book value. So that, again, is going to be $15,000, okay? We're going to add any gain recognized. So we're going to add 8,000 because we actually recognize the gain. Gain recognized means the amount of gain in your journal entry. Okay, gain recognized or loss recognized means the amount of gain or loss in your journal entry. Okay, so don't get that confused with, okay, I have an overall gain, because what we're going to see is that we'll have overall gains of a certain amount, but we might not recognize them all, right? Because that's when we have lack commercial substance. We don't necessarily recognize all of the gain. That's what we covered in our first video. Okay, so just to be clear, the gain on the disposal of the equipment that is actually recognized in the journal entry is the amount that will be go in our formula if we're using the formula approach. Okay, then we add any cash that we pay. Okay, then again, we're skipping the fair market value of other property given up and other property received. We're not looking at those because those are just more complicated than what we need. Then we subtract any loss recognized. We don't have any loss recognized here, right? We're not worried about that because we don't have any loss recognized. And then we subtract any cash received. We don't have any cash received. So loss recognized and cash received would be 0, which means we have new equipment for $25,000. That equals to the new equipment account. Okay? Then, so that's the first one, right? And that just proves that we've done it correctly. Okay, so that's the easiest situation for non-monetary exchange. Then we're going to have a different scenario. We have a loss situation, but we have commercial substance. Now we're going to assume that XYZ fair value of the equipment is $14,000 instead of $23,000. So right here, this would be $14,000 instead of $23,000. The fair value of ABCs is now $16,000 instead of $25,000. And why is this changed to $16,000? Because 14 plus 2 cash given up is equal to 16, right? And as we talked about before, we might want to cover that in the first example, but basically, as we talked about in some of the previous videos, basically, whenever we have these transactions, whatever is given up has to equal whatever is received. So for the first scenario, 23 plus 2 equals 25, right? ABC is giving up something worth 25. They're giving up a piece of equipment worth 25. XYZ is giving up a piece of equipment worth 23 plus cash of 2. That equals 25. Next example, XY gives up a piece of equipment worth 14 plus cash of 2. ABC gives up an equipment worth 16. Okay, so 14 plus 2 equals 16. Every single example that we're going to go over is going to be set up in that way. Okay, so basically the total fair market value of the transaction for the first one would be 23 plus 2, or just 25,000 for ABC, right? They equal to each other. So that's how we figure out the total fair market value of the transaction. We determine what is the total fair market value of everything given up, right? But we have to do it separately for both sides. We have to do it one on XYZ side, and then the other one is on ABC side. And again, the fair market value of the transaction for the second one would be 16, right? Because on XYZ side, it's 2,000 plus 14,000. And then on ABC side, 16,000 for just the piece of equipment. So that's what we want to be careful of, okay, is when we have these fair market values, what is the total fair market value of the transaction? We're going to need to look at that later, and we're going to need to know what that means, okay? So again, now we're going to say, okay, let's do the easy stuff first. The equipment still costs 20, and the accumulated depreciation still goes off at 5. We still pay out cash of 2. Those are the easy things, right? Literally the same as the previous journal entry. Then we have to determine gain loss. Okay, well, the fair value of the equipment is 14, the book value is 15. Again, where's the book value come from? Cost minus accumulated depreciation, 20 minus 5, so it's 15. So we're only going to get $14,000 for something, like if we theoretically sold this today for $14,000, that's basically what we're doing, right? When we're saying fair value, that's why we're using fair value for gain or loss. If we theoretically sell this equipment today for $14,000, which is what the market value is of it, right? It's fair value. That's what we would get. We would get $14,000 for something that's on our books at 15. That means we have a loss of $1,000. Okay. Again, if we have a loss situation, we are going to recognize gain. If we have a loss situation, that was not right. If we have a loss situation, we're going to recognize the loss. It says we have commercial substance, but it doesn't make a difference, right? If it says we have commercial substance, we recognize all gains and losses. However, if we lack commercial substance, we still recognize the loss immediately. So here we want to recognize whether this says have commercial substance or does not have. If the facts are the same as this and we have a loss, we recognize the $1,000 of loss. It does not matter, okay? Whether we have commercial substance, okay? Then the equipment account, we would just plug it. It'd be 22 minus basically 6. It'd be 16. Okay, let's do our formula really quickly. Before we do our formula, let's note one thing. When it says loss on disposal, gain on disposal of equipment, loss on disposal of equipment, make sure you're writing out the full name of the accounts, okay? On the exam or on a quiz, if you just write gain or just write loss, you're going to lose points, okay? That is not going to be enough to get points. You need to make sure you're writing out the full names of these accounts. There are potentially some abbreviations allowed, all right? But again, that is up to the discretion of the professor. And so don't assume that a specific abbreviation is acceptable. Okay, and again, gain and loss just by themselves are not acceptable. Okay, so let's do our formula approach. We start with the net book value of the old equipment. Again, that's $15,000 because it's just 20 minus 5. Then we add any gain recognized. That would be 0. We didn't recognize any gain, clearly. Do we pay cash? Yes, we pay cash of 2. Do we have any loss recognized? Yes, we recognized a loss of 1,000. Means we subtract that. Cash received is 0, so we subtract 0, which gives us 15 plus 2 minus 1 is 16,000. So that gives us the correct value for our equipment. Okay, and again, the rationale for all of these things is done in a separate video. I'm just going through these quickly to verify and just to show, okay, yes, these do work out with the formula. Okay, so I will go through all of them with the formula approach as well, but again, you want to make sure you have that formula sheet up with you, handy, and you also want to make sure that you've watched that video on the formula, because otherwise these things are not going to make any sense. Why are we adding? Why are we subtracting? Okay, so that is the first page. All right, so now we have the second page here. We're going to still need these facts, okay? So now we have same as original, but we lack commercial substance. Okay, now we lack commercial substance, okay? So we're in a situation where we're paying out cash, okay? We're paying out cash, and we lack commercial substance. So here we're in cash paid, which means we're going to recognize either all or none of the gain. We're recognizing all or none of the gain. And again, remember, we have to do our 25% test, okay? So let's figure this out, okay? So let's do the easy stuff first. Again, equipment, accumulated depreciation, and cash are all the exact same thing. We don't need to spend a ton of time there. We've gone through that now. This is the third time. We take off the equipment, we take off the accumulated depreciation, we take off the cash. The numbers are given right there, 20, 5, and 2, okay? The hard part is now the gain, okay? So we determined that the full gain is 8,000, right? That's the exact same as the beginning because the fair value is 23,000 and the book value is 15. Again, 20 minus 5 gives us the book value. $8,000 gain. Okay, if we theoretically sold this for $23,000 of cash, we would get $8,000 gain. Okay, now what we need to do is we need to determine, okay, are we going to recognize all or none of the gain? Okay, how do we do that? We have to do our little formula here to determine whether the cash involved in the transaction is 25% or more of the total fair value of the transaction. Okay, so how do we do that? Okay, well, we take the cash involved, which is $2,000, okay? It's told to us right here, $2,000 is the cash involved with the transaction, right? We see nothing on ABC side. We just see $2,000 on XYZ side. Then we have to divide by the total fair market value of the transaction. So this is the total fair market value of the transaction, okay? And again, like we talked about before, how do we determine the total fair market value of the transaction? Well, it's the fair value on each side of the transaction. So on XYZs, what are they giving up? They're giving up something worth 2,000, and then they're giving up something worth 23. So that's 25. On ABC side, they're giving up something worth 25,000, which is the equipment. Okay, so that means that the total fair market value of the transaction is 25,000 because they have to equal. Okay, each side of the transaction, the fair market value of what they're giving up has to be equal because we're rational economic agents, and it doesn't make sense to give up something that if you know XYZ gave up something worth 10 and then ABC gave up something worth 25, that doesn't make any sense, right? So the total fair market value of the transaction in this case is $25,000, okay? Because it's just basically what the fair market value of the transaction is on either side of the transaction, okay? And again, those have to equal, okay? So we'll see that if we do the percentage cash involved, it's only 8%, so we don't recognize any of the gain. Why is that? Because that's our rule. Right? When we have cash paid, we recognize either all or none of the gain. We recognize none of the gain if we're under 25% of cash being involved of the total fair market value. However, if the cash involved is greater than or equal to 25% of the fair market value of the transaction, then we recognize all of the gain for cash paid. Okay? And again, we're in the lacks commercial substance, right? We lack commercial substance. Okay? That's the issue here. Right? We lack commercial substance and we pay out cash. So we recognize all or none of the gain. And again, that's based on the 25% threshold like we just went over. Okay? So again, we recognize no gain. So we don't have to debit or credit any gain. We don't have to credit any gain, which means equipment is 17. We're using the plug approach, 22 minus 5. Then let's use the formula approach. Okay? The net book value would still be 15,000. It's still 20 minus 5, the net book value of the old property. The gain recognized is 0. The cash paid is $2,000. Then, do we have a loss recognized? No, we do not. We don't have any loss recognized. Do we receive cash? No, we don't. So that's 0. So that means that our new book value of the equipment will be 17. Okay, and it works out. Okay, so we have 17,000 here. We have 17,000 using the plug approach. Okay, again, these are two separate ways of solving for the equipment. You want to make sure on the exam that you're doing both ways, because if you're not, and you just do one way, such as the plug approach or just the formula approach, if you make a mistake on either one, you're not going to notice it. Okay, this way, it gives you assurance that you've done it properly, because if you get the same answer doing it two different ways, you should feel pretty good. Now we have that's the end of that scenario. Now we're going to pay out cash and we're going to lack commercial substance. So just flipping back to our initial sheet, okay? This is going to be a situation where we're going to be paying out cash, so we're going to recognize all or none of the gain, okay? So we're still in the cash received scenario. However, it's going to change a little bit. So now we're going to say that the cash is paid by XYZ is 9,000 and the fair value of XYZ's equipment is 16,000. Instead of 23,000. Okay, so now it's 16 instead of 23. The fair value of ABC's equipment is still 25. Okay, so basically, if we were to determine what's the fair market value of the transaction, well, it's $9,000 of cash plus 16,000 of fair value given up by XYZ, and then the fair value of ABC's equipment is 25. So it's just 25, right? Because on both sides of the transaction, $25,000 of value is given up. Okay, that's why the fair value of the equipment changes here, because the cash paid increases, so that means the fair value has to go down for it to still be $25,000, right? Because before we had $2,000 of cash, so if we bump up the cash by $7,000, that means we must decrease the fair value of the equipment by $7,000 to be able to keep it at a total fair market value of $25,000. Okay, now we need to figure out, okay, let's do the easy stuff. Okay, so again, accumulated depreciation goes off at 5, equipment is going out at 20,000. Cash is 9,000 now. So we're going to have to actually pay out cash of 9,000. We're going to credit cash for 9,000. Okay, now we need to determine gain loss. Okay, gain is 16,000 of fair value minus the 15,000 of book value. Again, that's the 20 minus the 5. We get a gain of 1,000. Now, again, we have to determine, are we going to recognize all or none of the gain? All or none of the gain when we pay out cash and we lack commercial substance. Okay, again, we do our percentage cash. We figure out that the percentage of cash is 36%. How do we get that? We take the $9,000 of cash involved, we divide it by the total fair market value of the transaction that we just solved for, and it's 36. So we recognize all the gain, right? Because we've hit or exceeded, in this case we've exceeded the 25% threshold. Okay? The 25% threshold saying once you hit this threshold, you recognize all gains because GAAP sees it as a monetary transaction at that point. And with a monetary transaction, you recognize all gains and losses. Okay, so now you recognize the gain of 1,000. Using the plug approach, equipment would be 25 because we would take 30 minus 5 equals 25. 20 plus 9 plus 1 is 30,000. Subtract away 5,000, we get 25,000. Okay, now let's do the formula approach, and then we just have one last problem. Net book value of the old property, again, is still 15,000. The gain recognized was $1,000. The cash paid was $9,000. The loss recognized was 0. The cash paid was, the cash received was 0. That means that if we add that up, we'll get 25,000, and it checks out once again. Okay, so again, we want to make sure we're doing both methods. Okay, so that's the end of cash paid lacks commercial substance. Now we're going to do cash received lacks commercial substance, and then we're going to be done with this video. Okay, it's getting a little long, but again, there's a lot of different potential options, scenarios, and we want to make sure we go through all of them just so that way we know how to do all these for the exam. Okay, so again, we're in the cash received. Let's just look at it. Cash received lack commercial substance, which means that we're right here, cash received. We recognize either part or all of the gain. Okay, and again, how do we know if we recognize part or all of the gain? It's the same test as we did for cash paid. It's just that it's going to be a little bit different with the math in terms of if we're recognizing a partial gain, it's going to be a little bit different. Okay, so basically, we do our 25% test, and then if we're under 25%, we have to recognize a partial gain, and if we're over 25%, if we're equal to or greater than 25%, we recognize all of the gain. Okay, so let's go ahead and see what the facts are. Assume XYZ, assume that now ABC is paying XYZ 2,000. So instead of XYZ paying, it's ABC paying now, and then the fair value of XYZ's equipment is 25 instead of 23, and the fair value of ABC's is 23 instead of 25. Okay, so that means that the total fair market value of the transaction is what? On XYZ side, they're giving up equipment worth 25,000. On ABC side, they're giving up cash worth 2, and then a fair value of equipment worth 23. which means that it's 25,000. So these will be equal, right? 25 equals 25. So the total fair market value of the transaction, again, is 25,000. It's just that basically it's the same facts as the initial one. It's just flipped, right? Because now ABC is paying the cash, which means their equipment's worth 23 versus XYZ is receiving the cash and their equipment is worth 25, okay? So now we want to do the easy stuff first. Again, equipment comes off the books at 20, accumulated depreciation comes off the book at 20. Now we receive cash of 2, so we actually have to debit cash for 2,000, okay? Now we have to do our gain or loss, and we have to determine, we have to do gain loss, and then we have to determine what we're going to capitalize into the equipment account, okay? So the gain is $10,000. How do we get that? Well, the fair value of the equipment is 25, okay? And then the book value is 15. So the total gain is 10. However, again, we're in a situation where we lack commercial substance. So we have to determine if we're going to recognize partial or full gain, okay? So to determine the percentage cash, we do 2 divided by 25. Where's the 2 coming from? Well, the cash involved is $2,000 paid by ABC. The total fair market value is 25. We did that before. Then we get 8% for our cash percentage, okay? So we fall below 25%. If we fall below 25%, that means we only recognize a partial gain. So how do we do that? Well, the way that we do that is in this case, we would take our 8% and we're going to multiply it by $10,000. It's going to give us $800 to recognize because this is the percentage of the cash received, and then the $10,000 is the total gain that we did from the other problem, okay? So right here, we should have $10,000 for this is the total gain. Okay, so this should be the total gain multiplied by the percentage of cash involved, and that gives us $800. We recognize $800 a gain. We do the math. We get $13,800 for the equipment, okay? Because $28,800 minus $7,000 is $13,800, okay? So the gain to recognize is $800. Again, the reason we're only recognizing a partial gain is because we're under the 25% threshold. If we hit or went greater than 25%, then in that case, we would actually recognize the full $10,000 of gain, okay? But because we do not hit or go over 25% of cash involved in the transaction, we must do the partial gain. So the first thing we do is determine what is the percentage of cash, which we've done like quite a few times now, like this is our third time, I believe, determining percentage of cash involved. Then the next step is to take the total gain, you multiply by the percentage of cash you just solved for, and that gives you the partial gain to recognize. Okay, so this is the extra piece for the when cash is received, okay? You can have the partial gain. And so to get the partial gain, you take total gain times the percentage, which is less than 25%, right? Because if it's over 25%, we recognize the full gain to give us the gain that we recognize. Okay, so now let's just do our formula. Old book value would be 15,000. Gain recognized is 18,000. Sorry, 8,000. I'm not sure. 800. Excuse me. I'm not speaking right. 800. The cash paid is 0. The loss recognized is 0. And then the cash received is 2,000. So if we do the math, 15,800 minus 2,000 gives us 13,800. And again, it ties up. Okay. So excuse the minor typo there, but this should be 10,000. And other than that, that's basically the end of this video. We could have done another example of where if it goes above 25%, you recognize the full gain. But again, if it was above 25%, you'd have 10,000 here, and then you would just have to do the math. So you'd have 30,000 minus 7 would give you $23,000 here. Okay, so if we went above, just so we could like see what that would look like really quickly, because we actually didn't have that scenario here. But if we did, okay, if it was the same facts except for the fact that somehow now something would have to change, because the cash could not still be $2,000. It wouldn't work. But let's just assume that we hit 25% or went above it. Okay, in that case, we would recognize the full gain, which would increase the amount that we had in the equipment account. Okay, so that is the end of this video, and I hope that was helpful. And again, this is also a complex topic, but going through the other videos along with this one should hopefully help it make a little bit more sense.